Hello and welcome everybody. I'm Stephen and I'm a popular investor on eToro and my username on eToro is 𝗃𝗶𝗱𝗲𝗏. Thank you very much for listening to this video today, and please don't forget to like this video. Take your time to like the video and then subscribe to my channel. That would be really appreciated. I really appreciate each and every one of you for listening. So in today's video, I will be explaining what happened in the markets last week. And I'm also going to be talking a bit about how our portfolio fared and giving my overview of the market. And the theme of today is quantitative easing versus quantitative tightening. And can both happen at the same time, which seems to be happening at the moment. So we will get started. So our performance for last week, we were up about 1.1%. That was reasonably good for last week. And if we compare that with the other major benchmarks, the Nasdaq was up about 1.7% and the S&P was up about 1.4%. And the reason why I think our portfolio slightly underperformed those two benchmarks was because crypto was mildly down last week. It was nothing severe, but Bitcoin was down about 1.65% and altcoins were down a little bit more. And I think that kind of contributed to a little bit of underperformance against the benchmarks. But overall, on a year-to-date basis, we are outperforming all of those major benchmarks. Our portfolio is up over 14.7%. And if we compare that with the Nasdaq, that's up 13%, and the S&P is only up a mere 3.4% for the year. The FTSE 100 is still down slightly for the year, although it improved last week, and that was up about that's down about 0.1% for the year. And then the Hang Seng Index, which is the Hong Kong indices, that's down about 1.08% for the year. And then Bitcoin is up a whopping 67.77% for the year. So basically last week the S&P 500 and the Nasdaq did rally slightly, as we saw from some of those gains that I just outlined. Europe and China rose moderately, just above flat, so they were a reasonably good week for Europe and for China. Bitcoin and crypto slightly retreated last week. There was a slight rebound of oil after a very negative week the previous week with oil. And then I did have some short-term success with some of my positions, short-term positions, which I have a small allocation in my portfolio in order to try to hedge some of the volatility and some of the risk from my other portfolio assets. So I did some short-term trades in natural gas, UK 100, and the Spanish 35 index. Those were all short positions in the UK 100 and the ESP 35 positions, and that does allow me to offset if there's some tough times in the market. It does allow me to offset some of those losses if the markets retreat. And what it's been working quite well over the last kind of month or so with the European indices and shorting them. And I've mainly been doing that because UK and the Spanish economy has a very heavy weighting for financial services industry. And it's a good way of me being able to hedge our risk. So I've been kind of going in and out of those on a short-term basis. And every time they kind of rally again, I will open short positions again, but it's only a small part of the portfolio. I also closed a longer term position in Activision Blizzard, and that was in a profit. I've held that for quite a long time, probably about 2 years now. And as we all know, Microsoft have acquired Activision Blizzard. The deal was just going through at the moment. There was a lot of contentious issues with the deal. However, it looks like it's going to go through, and I just felt that now it was at a good price. It wasn't very far away from the acquisition price, and I thought it was probably much better now that we closed out those positions and I can reallocate that money to potentially positions which I can get a higher gain from in the future. As we move on to the main news from last week, as I mentioned, the shares bounced back last week for Nasdaq and the S&P 500, and the banks have continued to suffer compared with other sectors. We all know about the issues that they have with Silicon Valley Bank, as well as Credit Suisse, Signature Bank. There's also been potential worries about PacWest and a few other banks in the US, but mainly kind of regional banks. But it's not looking as big of a contagion as originally thought. And I think that's mainly because of the US and the Fed really backstopping customer funds. So if customers have funds in the bank, then it's quite likely that the US government will cover them, even if the FDIC insurance only covers up to deposits of 250,000. So I think that's quite likely, and I think a lot of these banks are too big to fail, and I think the Fed will have to continue to support the banks along the way. But that does cause other effects, as I alluded to at the beginning of this video, because what's essentially happening is quantitative easing by banks increasing their balance sheets and having to support the banks, and also whilst simultaneously increasing rates at the same time. So we've got a scenario there where they are qualitative easing and quantitative tightening at the same time. So especially when we're in this kind of high inflation environment. So it's going to be pretty interesting to see how that goes over the next couple of months. We also saw at the FOMC meeting, the Fed raised their interest rates by 0.25%. That was the consensus, and that's what was expected, and that is something that went through. However, one important comment that was made by Jerome Powell at the last FOMC meeting in his speech, and he said that they can't see interest rate cuts happening this year, and he did acknowledge the tensions in the banking systems and how credit conditions have tightened. But it's going to be a situation really where they're going to have to see how it goes. But the markets don't tend to believe what Jerome Powell said at the moment, and it's more important to do what they do rather than do what they say. I mean, the Fed previously said that inflation was transitory, and then it turned out not to be. So the markets are still pricing in interest rate cuts before the end of this year. However, Jerome Powell said that that's very unlikely to happen. We also saw weekly jobless claims remained near 5-decade lows. So however, they have increased the interest rates significantly over the last year. However, the job market is still very robust. And as you can see, there's a very strong service sector in particular that requires jobs. We haven't seen a spike in unemployment claims or anything like that. So it does give you the feeling that they could increase the interest rates slightly further or hold them out at those higher interest rates for a longer period of time in order to try to not try to increase the amount of unemployment, but basically test the interest rates to limits, try to bring that inflation down to 2%, because they have a bit of slack there, because they have near historical lows of unemployment. We're also seeing current services and manufacturing activity, and there was data released on Friday, and that is jumped from 50.1 to 53.3, and anything over 50 is usually shows that there's expansion in the manufacturing and the economy. So this is kind of positive data as well. That's being shown that the economy is much more robust than had previously been expected. We are also seeing the Bank of England, they have raised interest rates to 4.25% from 4%, and that is the 11th consecutive increase. But you will see from in a couple of slides later in a chart that in the UK, the inflation is still going up slightly. So I think they still have some way to go in terms of increasing those interest rates, but keeping them there for longer in the UK. And that's why, especially with what's happening in the financial sector, I'm a lot more bearish on European and UK stocks compared with the US counterparts. We also seen UK financial markets. They appear to be expecting rates to increase again. There's no let up in inflation. And on a year-on-year basis, consumer prices have rose to 10.4% in February. So it's pretty difficult with the whole inflation situation in the UK. We also seen in the Eurozone, business activities expanded faster than expected in March. This is driven by strong growth in the services sector. The PMI rose to a 10-month high of 54.1 in March from 52 the previous month. In China, I think that there were a lot of expectations at the beginning of the year, and that's why we had such a steep rise, especially as China is coming out of those COVID-19 heavy restrictions and is opening up. However, there was a bit more softer demand than the markets had previously expected. However, I do expect that to improve over the next couple of months. We also seen the People's Bank of China has decided to leave its benchmark 1-year and 5-year rates at 3.65 and 4.3 respectively. And that is therefore the 7th consecutive month. And what that's showing there is China is continue to have kind of a soft monetary policy and continue with quantitative easing and supporting the economy in the best way it can. And that's pretty much very different to what's happening in the US and in Europe as they're increasing those interest rates and kind of tightening. We've also seen China economic indicators have picked up recent months as consumption and infrastructure investments rebounded from the pandemic lockdowns. However, many analysts predict that policymakers will maintain an accommodative stance due to the banking industry and other turmoil. As we move on to our top 3 performing stocks of last week, and our top performing stock last week was Sinclair Broadcast Group, something that I added to our portfolio a few months ago, has a very low valuation and sentiment is very low at it at the moment, but it had a really good bounce back last week. Our second best performing stock from last week was Ali Financial, and that was up about 8.5%. Sorry, that figure is wrong in the slide. And then the third best performing stock in our portfolio last week was Micron Technology, and that was up about 7.94%. So we did have some good bright spots. As we move on to our Death by Charts edition, I'm going to be talking about the chart now to our left. And the chart to our left really just shows that what the inflation is around the world and whether it's trending higher or it's trending lower. As you can see from the US, the inflation's at about 6%, and that's kind of trending lower. But as I mentioned, the UK is higher at 10.4%, but that is actually trending higher at the moment. So we're seeing good inroads made by the US, but less good inroads made by countries in Europe. And we've also seen similar with France, and Germany stayed unchanged, and a few other countries. So everyone is having these inflation issues. If we look at the chart to the right, I just wanted to show you the US existing homes median sales price. And as we can see, the median price on existing homes sold in the US now is down on a year-on-year basis for the first time since 2012. albeit they were very inflated in 2020, 2021, 2022. So that's come down about 0.2% on a year-on-year basis, but that is starting to trend down, which would actually be good for inflation and the shelter figures. So the third chart I wanted to show you is the annual changes in US household net worth. And the net worth of US households has fallen by 4.1 trillion in 2022. And that is the second largest decline on record after 2008. And this is a relatively small decline following the 2019-2021 record years in which household net worth surged to combined 45.9 trillion. So we are starting to see that average US household net worth is starting to decrease. And that is because really what we are seeing is we've seen a cost of living crisis. Lots of costs have gone up, from commodities to housing, shelter, and people's wages haven't increased, but we've seen a lot of increase in terms of inflation. So this is having an effect on regular US households. And we're also seeing the amount of loans, etc., that they have had to get, and credit cards debts increasing over time, and also lending facilities are a lot more stricter at the moment as well. The chart to the right I wanted to show you is stocks above the 50-day moving average, and they are still historically very low. So this does show sometimes can be a good indication of whether stocks are starting to be underpriced and whether they could be at good value. So I thought that was a very interesting chart as well. So as we move on now to the crypto news and views, I just wanted to highlight a couple of different things that were happening in the market. Last week, really, to be honest with you, was quite flat. It was a little bit down on both Bitcoin and altcoins, but Bitcoin and crypto is basically holding up very well this year. It's been a really leading performer, especially Bitcoin, because of what's happening in the financial system with the banks. And a lot of people are seeing Bitcoin as kind of a life raft, and it's something to kind of cling on to against fiat currencies, which are devaluing, and also depositors' money in the bank may not be as safe as they previously thought it would be. So we're seeing people investing in Bitcoin to have a stake in the network. So a couple of pieces of news from last week. One is about Custodian Bank. Custodian Bank was supposed to be a kind of a crypto native bank, and they put in an application to get a banking license, and they have been rejected. And I guess the main reason is to do with this kind of Operation Choke Point, to try and stop a lot of the crypto companies being able to bank successfully and easily, as we've seen what's happened with obviously Silvergate. Signature Bank was another big bank which helped crypto companies. So Custodian Bank was actually a slightly different concept. So they wanted to move away from kind of that kind of fiat concept. And what they wanted to do is, instead of doing the fractional reserve banking, which makes up all of the financial system, they actually wanted to over collateralize the deposits in the bank to make sure that there was no issues. However, this wasn't liked, and this was rejected, and mainly because I think that they are crypto facing, and the banks don't want to disadvantage some of those larger banks that have been in place for hundreds of years. Second piece of news is that Coinbase potentially could be in trouble with the SEC about the staking services, and they see it quite likely that over the next couple of months that they may be issued with a lawsuit for providing staking services for US customers. So it's another slight concern in terms of the regulatory front. And the last thing that I just wanted to bring up was that Do Kwon, who was in charge of the Luna Foundation, a very famous guy. Everybody knows that Luna and stablecoin lost a lot of money in 2022 for many investors, billions and billions of dollars worth. And he's basically been on the run, even though he said he wasn't on the run, from Korean authorities as well as US authorities. And he's basically been hiding out in Montenegro, and he has eventually been arrested in Montenegro. And it'd be very interesting to see whether he gets extradited and makes his way back to South Korea for further punishment, which I hope he does, because I think the least bad actors there are in this industry, the better it is going to be for the future. I now just wanted to bring up lastly some Bitcoin charts, and the chart to the left is the Bitcoin addresses with non-zero balances. I thought it was quite an interesting chart because the amount of Bitcoin supply that hasn't moved in at least 2 years is really on a tear. It's really starting to move, and it's making new all-time highs day after day. So that basically means a lot of Bitcoin has not moved over the last 2 years, and that number is continuing to increase, which is generally very bullish for the markets, because it means that less Bitcoin is being moved to exchanges and less Bitcoin is available on exchanges for people to buy, which makes gives supply constraints. Second chart to the right that I wanted to show you is the Bitcoin percentage of supply last active over the last 2 years. And we are starting to see the fastest growth in Bitcoin addresses with more than more than 0 BTC since early 2021. So we're seeing more fast growing Bitcoin addresses being created, which shows that the metrics of Bitcoin are growing despite being in a previous bear market. So thank you very much for listening to my video today. I'm going to keep it short. As usual, if you haven't already, make sure that you join my Discord group. Come and join our really lively gang of people talking regularly about the markets, people that are in the same boats as you. And you can also ask me any questions at any time. And until then, have a great week ahead.